So let's go. And the first thing, what is forex? Forex stands for foreign exchange market. It is a financial market where international currencies are traded. The forex market is decentralized, which means that there's no such thing as one forex stock exchange. So for example, there is you have the New York Stock Exchange, you have the London Stock Exchange, or commodities as well. There is the Chicago exchange. But in forex, you don't have that. You don't have one, or you don't have any real physical markets. And that's why we call forex is a decentralized market. At the same time, forex is the largest financial market in the world by daily turnover. Who is participating in the markets? Who is on the other side of your trades? Who is maybe trading with you? The forex market is very diverse. And first of all, we have the interbank market where the largest commercial banks interact and trade with each other. We have the central banks from all around the world, obviously. We have smaller banks then. We have large multinational corporations who have currency exposure. So any company that is interacting or making business internationally, and they make business in different currencies, usually they are also participating in the forex market, because when they have business in 2 or 3 different currencies, they obviously have a risk that one of the 2 currencies is appreciating or depreciating, and to avoid such risk, they also participate in the forex markets. Large hedge funds as well and retail traders, that's where we are. The forex market is very unique in a few different ways. Not only is it decentralized, but it's also open from Monday to Friday, 5 days a week, 24 hours a day. So Monday morning, when Australia and the Asian session starts, then the forex market opens for everybody all around the world, and it closes on Friday evening when the New York trading session is closing as well. And between that, it is always open 24 hours a day. Another very unique characteristic of the forex market or forex trading is that the currencies are always quoted and traded in so-called pairs, forex pairs. So for example, we have here the euro and the US dollar. It will be written like euro/USD on your broker platform. And it just means that how many US dollar do you need to buy 1 euro. So you always have 2 currencies quoted against each other. And when we take a look at our trading platform later on, you will see that we will always be trading those in pairs. Another thing is that it is possible to make profits, of course also make losses in both directions. So you can say, okay, I expect that the euro and the US dollar exchange rate, it will go up in the next, whatever your time frame is, in the next hour, in the next day, in the next week. And then you can enter a so-called buy trade, or you can go long, and then you can profit if the price on the euro US dollar is actually appreciating. But if you expect that, based on your analysis, based on the tools that we will later explore, if you think that the euro and the US dollar, the exchange rate will go down, you can also bet on that with a so-called sell trade, or you can go short. And so you can make profits also when the market is going down. This is very unique in forex, and it is a very good characteristic, because you're not only limited to one direction, but you can actually make money in both ways. So here, for example, we have the euro US dollar. This is clear, the market is going up here from the first arrow to the second arrow. If you enter a buy trade somewhere around here, based on whatever principle, we will explore them later very in depth, and I will show you exactly how to time and I will show you exactly how to time entries. Then you can make a profit when the price is rising. But as I said, if you expect that the price is going down in a certain period, you can see, okay, here the price was quite high. Then we have our analysis based on the tools that we use. We enter a sell trade here because we expect that the price is going down. Then the price is actually going down. We can close our trade. We can go out of the market again here with our profits. And so we can also realize profits when the market is going down. And that's it for our first basic introduction. What is the forex market? What are a few important terms? And now we will take a look at forex pairs in depth. So we will explore different forex pairs. I will explain to you the differences between forex pairs, and we will also start taking a look at our trading platform together. So see you in the next video. So now we will take a look at forex pairs. We will learn how to read forex quotes or how to read forex pairs. What is the difference between the two prices that you will have in your broker platform? What are spread? What is trading costs? And we will take a look at the different forex pairs. So as I said, the currencies are always quoted and traded in pairs. And you have your first currency here. It is called the base currency. The second currency is always called the quote currency. And then if you have the price here, it shows you how much US dollar you need to buy 1 euro. So that's quite straightforward. But as I said, there are unique characteristics in Forex, and since you can buy and sell Forex pairs, you will also have two prices in your broker platform. We will take a look at that shortly. I just want to explain the different terms for you that you already have heard about them. So we have an ask price, and this is the price the sellers are willing to sell for. And it is the price you have to buy when you enter a buy trade. So that's the most important. Ask means that's the price you have to pay when you enter a buy trade. Then you also have a bid price, and this is the price that you have to pay when you enter a selling trade. So you can see that here, this is a snapshot from your broker platform. We are using MetaTrader 4 here mostly during this course. I will show you in the next video how to install this trading platform, and I will also give you a quick rundown, and then we will look at this platform together, and you will have a very deep understanding at the end of this course. But to get started, this is how it looks like. You have your symbols here on the left hand side. Symbols is the different currency pairs. Some brokers also allow you to trade other markets, such as cryptos here, or CFDs, which are contracts for differences on stocks, for example. But we will focus on Forex for now. You can see here we have the euro US dollar. The bid price is the 1.15297, and in this case here it is even the same ask price because this broker has such a small spread. But you can see here, for example, on the US dollar and the Canadian, we have a bid price of 133.452 and 133.457. So there's a little bit of a difference, and that's the difference between the bid and the ask price. The difference between the bid and the ask price is called the spread, and this is the cost of entering a trade, and it's also the way how your broker is making money. So when you are starting and when you're opening a trade, you will see that it always starts in a slight negative loss in your broker platform, and this is how the broker is making its money on your spread. There's a second part of costs for trading. It is called the swap, and you will see that if you hold a trade overnight, then your broker will charge you a swap automatically in your broker platform. You don't have to do anything. It will automatically be deducted. Usually it's quite a small fee depending on the pair and also how long you hold it. But generally, swap is not that large of a cost. And we have swap in trading because there are different interest rates in the different countries. So for example, if we trade the euro and the US dollar, and the euro has a different interest rate than the US dollar in the central bank, then there will be a difference, and this difference is called then, or it is calculated for the swap price. Sometimes the swap can also be a part of your profit. If the interest rates are in a certain combination, then the swap will be credited to your account because it's part of your profits. In Forex, we generally distinguish between three categories of Forex pairs. We have the majors, which are the most traded Forex pairs. We have the minors, which are less traded. And then we have the exotic pairs, which are, as the name suggests, the exotic pairs. So here is a little breakdown, and we will take a look at that in our trading platform together. We have the majors here. The most important ones are the euro US dollar. It's by far the most commonly traded US dollar, and the Japanese yen. The British pound against the US dollar, also sometimes called the cable. We have US dollar and the Canadian dollar, which is called the loonie. US dollar and the Swiss franc. The Australian dollar against the US dollar, called the Aussie. The New Zealand dollar against the US dollar is called the Kiwi. So those are the commonly traded and the most traded Forex pairs. Then we have minor Forex pairs, where we then also have some of the crosses. So euro and the Japanese yen, the Australian dollar and the yen. And then we have exotic pairs, which are currencies probably not many have heard about, or they are not as common. So here we have, for example, the Turkish lira, the Swedish krona, the Norwegian krona, and so on and so forth. So what are the differences between the majors, the minors, and the exotic pairs? There are mainly three different differences. So first of all is the spread. On the majors, the spread is usually the lowest. So that means that trading the major forex pairs is usually cheaper because obviously the costs are lower. The volume is also higher on the forex major pairs because more people are trading them. And the volatility, which means how much is the price moving, is larger on the minors and the exotics. This means that the major forex pairs, on average, they move more smooth, they move clearer, they don't move as erratic, whereas the minors and especially the exotics, things can get very, very wild at times where you have big swings, a lot of up and downs in a short period of time. And so in the beginning, often traders say, better stick, if you're a new trader or if you're an inexperienced trader, better stick to the majors and the minors. And at the beginning, you should avoid the exotic pairs because things can get very wild at times. Also, one thing we have to understand is that in Forex, we have different trading sessions. In the beginning of the first video, I said that you can trade Forex 5 days a week, 24 hours a day. There are no opening and closing times during the week. This is a very unique characteristic, but we also have to understand that during the day there are different trading sessions. So for example, we are starting usually the day with Tokyo and the Australian trading session, and then we move on afterwards to the European trading session, Frankfurt and London, and then later on the American trading session with New York. And it means that during the day you will see different ways of how the forex pairs move. It means that, for example, when the Tokyo Stock Exchange opens, then usually you will see that the Asian currencies move more. So the Japanese yen, for example, is moving more usually during the Tokyo session compared to the New York session. Whereas when the European session with Frankfurt and London are open, you will usually see that the euro and the Swiss franc and the British pound are the most active forex pairs, and they don't move as much during the Australian session because during the European session, the European brokers, the European banks and the European central banks, they will trade the euro more actively, and they are not active during the Sydney session. Of course, there are also and always exceptions to those rules, but this is a general characteristic. So now we will take a look at our broker platform together. I will just give you a quick introduction. In the next video, I will then show you how to install this broker platform step by step, how to get going. And then once we get into the next module, we will take step-by-step look at our broker platform. I will explain to you all the different buttons, all the features, how to organize your charts, how to organize yourself, and how to get the most out of your platform. So see you in the second part in just a moment. So we are back now on our broker platform, and when we look here at the left hand side, you can see the different currencies. When we just scroll down, you can see how many there really are. And we start here at the top. There are usually the major forex pairs quoted, and you can also see we have the bid and the ask price here. You can see there is a difference. The ask price is always higher than the bid price, and if you want to enter a trade, then you have to buy the ask price if you want to buy trade. But we can see that here. So when we right click on the broker platform, we go to trading again, to new order. Then you can see here you have the two buttons for sell and buy, and the buy price is always higher than the sell price. So here we have the ask price, this is the sell price, and you can also see them here on the left hand side. On top you have the buy price, which is the ask price. At the bottom you have the sell price, which is the bid price, and you can see that there's a difference between the two prices. While we are at it, you can just simply change the currency you see here. You can see right now we have the Australian dollar, Canadian dollar, but if we want to take a look at any other currency, let's say the euro US dollar, we just simply drag it here, and then you can see it changes, and now you have the euro US dollar here. You have the prices here on the right hand side we can go back to trading and new order again, and then you have the bid and the ask price here again. And that's it for this video. By now you should have a good understanding about Forex in general, the very basics of Forex trading, know the differences between bid and ask price, and also how currencies are quoted. In the next video I will show you how to install this broker platform step by step, and then we will get into how to enter your first trade. And afterwards I will show you how to read price charts and how to make trading decisions step by step. Until then, see you in the next video. And in this video I will just show you the basics of MetaTrader, what you need to know about it, and how to familiarize yourself with this program. So first of all, if you don't like the way it looks, you can just right click, and here under properties you will then see a way of styling your different charts. And so you can, if you don't want to have the grid in the background, you think it's annoying, you can turn it off. You can also change the color scheme if you would like that. So if you prefer the white on the black, you can do that as well. And you can see it looks very different. You can also use the plus and the minus buttons on your keyboard to zoom in and zoom out. But you can also use the buttons here for the magnifying glass. And you can see that everything looks very different already now. If you want to change the currency pair, you can just left click and then drag it in here, and so change the different currencies. You can also, of course, have multiple currencies here if you don't want to just look at one. So you can right click into one, you just make a new chart window, and then you can see now we have the GBP here, the US dollar Canadian here, and so you have different charts. You can also have them side by side, so you just go here to a window, and here you have the different visualization options. If you want to have them side by side, you just choose this one, and then you can see you have the different charts here side by side. If you want to create a template as well, you can do that here. Just go to templates, save template, then we will call it new for the sake of this example. And when we go now to this one, you right click again, go to template, and here we see our new. And now we have also made a template, and we can use that across different charts if we want to analyze charts with our template view. Here then you have the different time frames, and to get started you can see that we have those bars here, and we call them candlesticks in trading, and every candlestick represents one time unit. So we are now on the M1, which is the 1 minute chart. So every time 1 minute passes, we get a new candle, and if we go 1 minute forward, then this candle will close and we will get a new candle. But we can also change to 1 hour if we want to get a broader overview, and now every candle represents 1 hour. And you can see how price moves during the duration of 1 hour. And now if you change the time frames, you can get a different overview of different markets and also different periods. So the higher you go with your time frame, the more historic price action you will see. And the lower you go, the more detailed the price action is, and the less historic price action you will have on your charts. There are a few different other things that you can do here. You can choose between the candlestick, as I showed you, this is what we have right now. You can also go to the line graph, and this is probably what you know. Let me get rid of this one first. So this is the line graph. This is usually what you see in TV and in financial media. And you can see that price is currently here. And if now we are on the 5 minute chart, if the 5 minutes are over, we will just move one step further, and then you will see that a new line period is created. You can also go to bar charts. They are essentially the same as candlestick charts, and we will explore them later as well. You have other things like you can make annotations here, you can write on your charts, and you have different charting tools which we will explore later step by step. And then you also have things like indicators. They are here, but we will get into the indicators later on as well as we progress through this free forex trading course here. And so this is how you get started. You can familiarize yourself with your broker platform. If you right click, you will see this drop down again. If you want to enter a trade, you go here to trading. You can go to new order then you will see this pop up here. You can again see the sell and the buy price. The prices are here. The difference between the two prices, as we covered, is called the spread price. The volume is the different sizes, which we will explore later. And that's how you can enter a trade. And if you are in a trade and you want to see what happens, you can go to view, and then you open your terminal, and here at the bottom you see your terminal. So if you are in a trade, you will see this listed here. You can also then see the profit go up and down depending on what price does. This is the swap, as we called it, another part of the cost of your trading. And then you have other things here when you open a trade. The account history, if you have done a few trades, you will see then a list here with all your past trades, and this is all showed in your terminal. I suggest you just click around a bit, you familiarize yourself a little bit with this tool and this platform. We will spend quite a few time on this later on, but if you don't understand much, don't worry, we will get into the specifics later on step by step, and I will show you everything that you need to know about MetaTrader and how to read and understand price charts. Welcome back, and now we will take a look at the different order types in forex trading, and in the second half of this video I will show you how we enter our first trade in our broker platform. So there are only 4 different order types in forex trading. The most commonly used one is the market order, which means that we enter a trade and it gets executed immediately right at the market price. In contrast to that, we have a limit order or a pending order. Those orders get executed not right away, but you can set them, for example, below the current price. Let's say the current price is at $100 and you want to have a pending order at 99. Then you can set the limit order to $99, and once the price gets to 99, the order will get executed there. So this is also very convenient. For example, if you cannot be in front of your broker platform all day long, but you have done your analysis, you come to the conclusion, okay, I want to get in at a certain price, but not at the current one, then you can just place a pending order at the certain level, and you can close your trading platform, and then it will get executed automatically. Then once you are in a trade, we have two order types, which then automatically close your trade for a potential profit or for loss. So once we are in a trade, we can set our take profit order at a certain profit price. So let's say, for example, we have entered a trade at a certain price, and we want to get out once the price makes a profit of $200. We can then do that with our so-called take profit order. We will set it at the price in our broker platform. We can close the broker platform, and then the broker will automatically close our trade once the 200 profit has been reached and we are out of the trade. We don't have to watch it, and the take profit order will do that. In contrast to that, we have our stop loss order. So not always does the trade obviously go in our favor, and if you want your broker to automatically close your trade at a certain loss size, you can do that with a so-called stop loss order. Slippage is a very important point as well. Sometimes, especially when the market is moving quite fast, and this is especially true for the exotic pairs, or sometimes during news events, we have something called slippage. It means that the order and your trading order, they won't get executed at a predefined price, but at the worst price. So if you want to enter at a certain price, or if you press the buy button right now, but there's a lot of news, the market is moving a lot, then it can happen that you get an entry at a worse price, and this is what we call slippage. So there's really not much more to that at the theoretical level. So I think it makes more sense to look at a few chart examples and to look actually at our broker platform, how we enter our first trade together. So let's switch over to that. So now I will show you a few examples about the different order types, and then it will become very clear what those are and how to use them. So you can see we are right now here. If we want to enter a market order, which I explained as the first example, the market order is the one that get executed right away. So we do the right click, you go to trading, then you go to new order. And then if we want to enter a buy trade for a market order, you can see here also it says market execution. Then you just click here on the buy trade. You wait a few seconds until the order is processed, and then you can see that the order is now in the market. You have the notification here. You can go to OK. And now if we open our terminal, you can do that with Control and T. You will see that when we go to trade, here is our trade right now, the order number, which is here, the time. We entered a buy trade. This is the size. We will get into this later. The symbol, this is the British pound US dollar. The price where we bought, this is here right now. The stop loss and the take profit we will explore later. The commission, the swap right now is 0 because swap is only calculated overnight when you hold the trades, and you can see your initial balance was 10,000 US dollar. This is your floating account balance right now. And so you can see what happens when you enter a trade, and this is a market order. So if you want to set a stop loss or a take profit order, this is very easy. If you can just do that with drag and drop. So if you hover over this entry price here or this entry order, which is this green dotted line, you can just click, hold the mouse and then drag it down. And then you can see that we have now created a red line. And if we look a little bit here to the left, you can see SL, which means stop loss order. And you can already see that MetaTrader automatically calculates the risk here for you. So if you place your stop loss order right now here at this level, you first have to accept the terms for the one-click trading, read them and then confirm them. So again, we click here, we drag it, and let's say we want to have a risk of $80 because we think this is a good level for our stop loss price. Then we just release it here. You can see the stop loss has now updated and our stop loss is here now in the market. It works the same on the opposite way. So if we click again here, we drag our mouse up, you can see that here on the left, you can see now TP, which means take profit order. And you can also see that if we put our take profit here, it shows you that we have a potential profit of 214 US dollar. And if we place it here now, you can see we have set our take profit order, and if price reaches this level now, then we will get out of the trade. The trade will be closed automatically for the potential profit. You can see it again here if we hover over this for 214 US dollars, and at the bottom you have your stop loss with a potential risk of 67 US dollar. So if price reaches your stop loss here, then this trade will be closed automatically. You will be out of the trade. The loss will be credited to your account. And you can see here the take profit and the stop loss have now updated. And those are pending orders as well. So you can see price is now moving a little bit up. You can see here if we zoom in, that price is now going up. This is our initial entry price we bought here. And you can see that the profit is going up now as well. And you can follow this if you want to get a feeling for what happens. But in a later video, I will show you how to correctly choose the position size to get a good risk and to calculate your risk actually. But this is just meant to get an understanding of how to enter a trade right now. We can right click on this one and you can see you have two options now. You can modify it or close it automatically. So if we click on close, this trade will just be closed. But if we go to, then this window will pop up again. You can see you can modify it. If we go here to type and modify, you can change your stop loss and your take profit again. But if you want to have a market execution, remember, market means that whatever we do will be executed right now. And now you have this button here which says close. So if you want to close your position, you just click here. And now you can see the terminal is empty. There is no trade anymore. But if we go to account history, you can see that here's our trade which we closed. This was the buy trade on the British pound US dollar. Here you have things like the price, the stop loss, the take profit, the date when you closed it, and also the profit we made. We lost 7 US dollars. And so you can see here that this is now your new account balance, 19,986, because there were also 7 US dollars commission in it. And this is how you use the market order, stop loss, and also take profit orders. Thank you for watching and see you in the next video. Hello, welcome back, and let's talk about the time frame choice and also what forex pairs you should pick, because in this context it fits quite nicely. One size fits all doesn't work in trading, whether it is about the trading style or the way you approach trading, but it also applies to time frame choice in a significant way. As you have seen probably already in MetaTrader, you can choose between a variety of time frames. We start mostly from the monthly, the weekly, which most traders don't trade, the daily, the 4 hour, the 1 hour time frame. 1 hour is very famous. Then when we go to the lower time frames, we have the 30-minute, 15-minute, 5-minute, and even the 1 minute. And those are very, or the choices is the choice that you make for what time frame you want to follow has a lot of implications, and it will affect your whole trading. And you have to ask yourself first, what personality type are you? How do you work best? Or what is your skill set? What are your strengths? What are your weaknesses? So let me walk you through a few questions that you need to ask yourself to make the right choice when it comes to time frame choice. So are you a fast thinker? On the lower time frames, especially when we go below the 30-minute, 15-minute, especially 15 and 5-minute, you have to react quite fast. You cannot plan your trades the same way you can plan them on the 4 hour or the 1 hour or the daily time frame. You have to make decisions quite fast, because you will get a lot of signals or potential signals in a day. Not all signals will lead to a trade. Sometimes you have an almost signal and you have to pass on it. And there are many actions and many decisions you have to make during the day. Or on the other hand, do you like the long-term strategic thinking? That's what I prefer, which is why I mostly trade the 4 hour time frame and the daily time frame, sometimes the 1 hour, but rarely. And if you like this way of trading, where on the weekends or at the end of the day, you have time to look at your charts, and you can really plan out what you're going to do the next day, because, for example, on the 4 hour time frame, you only get 6 new candlesticks in the day. So there's only so much that can happen during the day, and you have more time to plan everything. But this also has a downside, as we will see shortly. Another question you need to ask: are you emotionally stable? Many traders, they like to trade the lower time frames because they think they get more action and more profit potential, but they overlook the problem that the lower time frames have. And if you are not emotionally stable and you experience a loss, then it can quickly lead to this vicious cycle where one loss leads to the next, where it leads to bad decision making, maybe revenge trading, chasing price, entering bad trades. Because on the lower time frames, you get many signals in a day. You will see many candles, many potential signals, as I said, and you need to shake off a loss quickly to move on to the next trade and follow the next trade objectively. If you are, on the other hand, not stable, and you easily get irritated if you have a losing trade, but then in a few hours or in a few moments the next trade is presenting to you, you have to shake off the previous event, whatever it was. Maybe you're even over optimistic if you have a winning trade, and those are the things that really interfere with your decision making. And if you're not emotionally stable, then the lower time frames might not be the best choice. Or at least you can be aware of that emotional stability has a big influence on the lower time frame, and you can integrate that in your decision making. How patient are you? On the higher time frames, sometimes you can go hours or even days sometimes without a trade, and that is normal, and you have to deal with that. Especially in the beginning, many traders make the mistake that they believe in order to be a trader you have to trade. That's not true. And the less you trade, the more selective you are, usually the better your trading will be. But on the higher time frames, things move slower and you have less signals. That's one thing as well you need to consider. And also, of course, what is your daily schedule like? How much time do you have? Do you have time to actively trade for a few hours, maybe a session? Then the lower time frames can be an option if you think that's where your strengths are. But on the other hand, if you are quite busy during the day, then squeezing in a few moments here and there to actively try to trade the lower time frames is probably not going to be the best fit for you. Consistency is key. This is very important in trading. whether it is about the trading system and the rules you follow, or it also comes down to the time frame choice. Many traders make the mistake that they jump from time frame to time frame. They don't have any consistency in their approach. One day they will trade the 15-minute, the next day they will be on the 4-hour, then the next day they try to scalp the 1 hour, the 1 minute time frame, and they're all over the place. And every time frame, as I said, requires a very different skill set. So if you trade the 5-minute one day, the next day you go to the 4-hour time frame, you will not really learn a lot about yourself as a trader, and you will also not be able to improve your trading skills, because every time you need to really restart from scratch. You need to adapt to the time frames. That's not a mindset or not a place where you want to be in. You want to be able to consistently, hard word, come to the same time frames every day, train yourself on those time frames so that you can actually become better. So my tip in the beginning, choose 2 time frames maximum. Even if you want, choose just 1 time frame that are reasonably close together. So for example, do you like to trade the 4-hour and the 1 hour? That's a good combination. It's also a good compromise between the very, very short time frames, 30-minute or 15-minute, and the very high time frame of the daily. 4-hour and 1 hour is a good combination. Or do you tend to go or to gravitate more toward the higher time frames? The 4-hour, the daily is a good combination. That's the one I trade mainly these days. Or do you like the lower time frames? Maybe 1 hour, 30-minute, or 30-minute, 15-minute. Those are good combinations. And then stick to them for at least a few months. Observe yourself. How do you like those time frames? And really pay attention to the time frames and yourself. How do you deal with certain things? Especially go back to the previous slide. Ask yourself those questions over and over again. Observe yourself, how you react to certain things, and then you can find out what type of trader you are, what works well for your personality. Improve and adapt. After a few months, you will see how you really like those time frames, if they really suit your skill set, and if they don't, make little improvements, make little adjustments to improve and adapt to the situation. And then, of course, the way we choose our time frames also influences the forex pairs that we should or could be trading. There are 2 general distinctions on the lower time frames. Usually you focus on fewer markets and fewer forex pairs because you will easily lose the oversight if on the 5-minute time frame you get so many candles in a day, and then if you at the same time try to follow 5 or 10 forex pairs, that will become very, very hard to manage, especially in the beginning. Stick to the majors is a very good point in the beginning, especially on the lower time frame. So if you trade the 30-minute or the 15-minute, even the 1 hour time frame, you can stick to the majors only. There are enough majors that you will still get plenty of trades a week. And again, more trades isn't better. Be selective and choose the trades. On the other time frames, on the higher time frames, on the other hand, you generally follow more forex pairs, because on the 4-hour time frame, for example, you only get 6 new candles in a day. You only get roughly 30 candles in a week. That's what you get on a 1-hour time frame in a day. So the market or the forex pairs will not generate as many signals on a 4-hour time frame on any one pair. So you have to be you have to follow more pairs, but you have more time. As I said, also you can take the time in the evening or on the weekends to really plan your trades and really analyze the markets. We will come later to a lesson where I talk about market selection, which is very important, and especially for the higher time frames, it's a very important topic. So if you follow the higher time frames, 4-hour and higher, then I would recommend at least follow all the majors and follow most of the minors. The exotics in the beginning maybe not so much, but you can follow a wide variety. And then what allows you to do is you can be very, very picky. You can only take the best trades. If you think that this trade is not perfect, then skip it. You have enough other forex pairs in the majors and the minors that you can really choose and really, really be selective. And with those principles and guidelines, you can already start shaping your trading a little bit. In the next modules, we will talk then about actual price analysis, how to read charts, how to time trades, how to enter trades, and what tools to use. And in the first part of this video, it will be a little bit theoretical. I will explain a few important terms and concepts. And then in the second half, we will take a look at how to actually size our positions to get a certain risk in our trading platform. So let's get started. And what is a pip? A pip is, or it stands for point in percentage. That's usually how traders in Forex measure distances on their charts to determine how far the price is going or how far a take profit will go, and also how far your stop loss will be. And this will then help us to scale our positions to achieve a certain risk that we want to have for our trades. And in Forex trading, when we enter a trade, we can choose between different position sizes. There are generally three main position sizes or ways that we talk about positions. And the first and the smallest one is 1 micro lot. It means 1 micro lot stands for 1,000 currency units. And if you trade 1 micro lot, then 1 pip equals 0.1 US dollar. The next higher size is 1 mini lot. A mini lot is 10,000 currency units. Obviously, 10 micro lots will also give you 1 mini lots. We will see that in our MetaTrader platform. You can choose a mini lot or 2, 3, 4, 5, 6 mini lots. And once you get to 10, you will get to 1 mini lot. And for 1 mini lot, 1 pip equals 1 US dollar. 10 mini lots or 100 micro lots are then 1 standard lot. And in MetaTrader, this will just be, when you enter position size, it will just be 1.0 as your quantity or your position size. 1 standard lot equals 100,000 currency units. And if the price moves 1 pip on your charts, if you have entered a trade with 1 standard lot, it means that 1 pip equals 10 US dollar. I know that's a little bit maybe confusing, many terms at once, but once we get into the charts, it will become quite clear. I just want to prime you for the different terms. What is leverage? Leverage in trading is important. It is a very often and controversially discussed topic. Basically, it means that you are trading with borrowed money. You can trade larger sizes than what your account offers you at the moment. So, for example, if you want to trade 1 standard lot or 100,000 currency units, you don't actually have to have a trading account where you have 100,000 US dollar or 100,000 euro. If you use leverage, you can have a much smaller account, still have higher position size or trade large position sizes. So for example, if you trade and if you open a trading account, you can choose the leverage with your broker. And for example, let's say we choose a leverage of 100 to 1. Then it means you could enter a position that is worth 100,000 US dollar only by buying 1,000 US dollar. You can see 1,000 times 100 from your leverage will give you the 100,000. Of course, very small price movements then also will lead to very large fluctuations in your account, and small price movements can wipe out accounts quickly if you use a large leverage and in combination with large lot sizes. So there are a few principles for position sizing that I would like to share for you. It's very good as a beginner to stick to them so you don't risk losing your account all at once or encounter big losses early on. Generally, traders should not risk more than 1% per trade. What is 1% and how do you get that? This is what we will do in the second half of the video, where we will actually size a trade together. So this way you can have a string of losses and you still be able to trade. Even if you lose 5 or 6 trades in a row, you will lose 5 or 6, 7% of your trading account. It's not that much in a percentage base. You can still recover quite quickly if you have a few good trades. And you want to be in that position where even though you lose money, losing money is not pleasant, or losing a trade in general is not pleasant. But if you stick to smaller position size, the 1% rule is good for beginners. You will still be able to recover, because protecting emotional capital is very, very important. Emotional capital means that you still enjoy trading, you don't fear it, you don't have encountered large losses where you dread trading, where you are fearful maybe, and you need to really protect your position or your emotional capital, and that is done by managing small positions and getting into trades with smaller positions. So let's go through an example here. Let's say you have a trading account of 5,000 US dollar. 1%, as I said, of the 5 is the 1% rule, and 1% of 5,000 US dollar is here 50 US dollar. So on every trade, you would risk 50 US dollar, and when your price hits your stop loss order, you will then lose $50. Of course, stops are not guaranteed, and you should read the small print in your broker's risk disclaimer, especially when a price moves significantly during volatile phases. Stops will not always get executed at certain levels. That's very important. But at the same time, you should never ever trade without a stop loss in the first place. Also, if you don't have a stop loss, you don't really have a way of sizing your positions. So the first step is that you define how much is 1% of your account. In this case, it's 50 US dollar. And now in the second step is that we measure our stop loss distance on our charts. When we enter a trade, we find how or where we want to put our stop loss, and then we can measure the distance between our entry and the stop loss. And once we have that, whether it is 5 pips, 10 pips, or 50 pips, then we can calculate the right amount of lots bought. Don't worry, we don't have to do that manually. There is a position size calculator, which I will put a link to in the description below. And also we will take a look at now. Once we dig into the charts, we will make an actual step-by-step example together, and I will show you how to size your trade correctly. And welcome back to the second part. Now we will go through a trade or example together where I show you exactly how to size a trade the right way. So here we are in our trading platform, and I've pulled up the Euro US dollar. You can see this is a broker where you have 5 decimals. And I said in the PowerPoint that in trading or in forex trading in general, we use pips. But when you have a 5-digit broker, you will get pipettes instead of pips, which means that 10 pipettes are 1 pip. And I will show you exactly how this works. So you can click your mouse wheel. If you don't have a mouse wheel, you can just go here for this crosshair, and then you will see you have, as I said, a crosshair. You can now just click on any one part of your trading platform, hold the mouse button. You can see now there is a number which is changing when I move it up or down, and those are the pipettes. You can see now it is at 130, 20 to 102, and those are the pipettes. So we have to divide it by 10 to get the pips. So in this case we have 20.2 pips. This is just more accurate way of showing the pips actually, because when the broker charges the commission or adds the commission to the trade, usually the commission is somewhere between 1.6, or at least you have a decimal as a commission figure. So if you see that you have pipettes, then the commission and everything else will be a little bit more accurate. That's the only reason. And you can see you can use the crosshair here now to move to measure the price move. So for example, from the top here to the bottom, these are 1,910 pipettes, which is 190 pips. From the bottom to the top, we have roughly 160 pips. And you can see this is basically all there is to measuring pips. When it comes to position size calculation, we should open our terminal, which is here. I think you cannot see it. Let me move it down a little bit. So it's here. It will open up this little window. It's also the Control T, the shortcut. It will open up here. You can see you have other tabs here. And I just opened a new demo account to show you. I set it to 5,000 US dollar. And now we want to enter a trade where we have a risk of 1%. As I said in the PowerPoint, 1% of 5,000 is 50 US dollar. So we want to risk 50 US dollar. Let's say we want to enter a trade for at this current level for whatever reason, and our stop loss is a buy trade. That is, we want to open, and this is just an example. There are no rules. This is just for an example of how to size a trade. So let's say our entry will go here. The stop loss will go at this point. Let me actually use a horizontal line. So the stop loss just goes here, and now we have to measure the distance between the current price and where the stop loss will go. So for that, we just use our tool, our mouse crosshair tool. We will go to the current price, then just drag it down, and you can see we have, let's call it 18.1 it was. So let's call it 18 pips. So now we go to our position sizing calculator. This is the one from Baby Pips. I will put a link to the description below the video. So now we just have to fill it out. You can see here we have everything. Account currency is US dollar. We have a $5,000 account. We want to risk 1%, and the stop loss was 18 pips. The currency pair is the euro US dollar. We calculated, and you can see we have to risk, or the risk will be 50 US dollar. You will risk 27,700 units. This equals 0.2778 standard lots, or 2.7 mini lots. The way MetaTrader works is that you will always buy standard lots, so we have to enter 0.28 since we cannot go that deep. So let's just go here on trading. We go to new order, and now you can see we have everything here. We can order 0.28, and then we will just enter a buy trade, as I said, buy the market. So it means that the trade will be executed immediately. We have market execution here. We could also enter a pending order, but we want to enter a market execution. We buy now, and you can see the trade was executed successfully. You can see now we have here all the things that belong to it. We have a commission, which is already charged here automatically, the entry price, and now we want to put our stop loss to 18 pips. As I show you, you can just move your you click on here this green line, and then you just drag it down to get the stop loss. We want to set it now to 18 pips. Let me just zoom out. We have to accept the one click trading conditions again, read them before. And now let's zoom in so we can actually see what is happening here on the left hand side. So we drag this down, and you can see once we get to minus 180 pips, 85, 80, you can see when we hover over now, let me delete the line. And when we hover over the stop loss, you can see our profit is now minus 50.4. So you can see this is very, very accurate. We have now risk 50 US dollar. If the market will go down to hit our stop loss, we will be out with 50.4 US dollar in a loss. Of course, sometimes the stops won't get executed in times of high volatility, and this is something you have to consider as well. That's the risk of trading. And now you have correctly sized a trade. You can see the price goes up and down. You can see we are now in a profit. The stop loss is here. And now let's just set a target. For example, we again click on the entry order, and when we move the mouse up, you can see now here we have TP, and this is the potential profit. And you can see here when we move up and down, the value will change, and so we can set our take profit order as well for a potential profit of 214 US dollar. And when the trade reaches this area, it will get executed, and the trade will automatically be closed and credited to our account. And that's all there is to position sizing. So you have it won't take that long when you do it on your own. You just have to determine where's your current entry price, how far is the stop loss, using here our crosshair tool. Once you have the pips, you just go to the Baby Pips calculator, put in the numbers, you will get the standard lot size, and then you can just size your position. That's it. I hope you enjoyed that, and I will see you in the next video.